All right, let's get straight to it. Gurugram's real estate market has fundamentally changed. The old playbook, the speculative, volume driven bets, it's obsolete. In this briefing, we're going to do an institutional deep dive into why Gurugram has transformed into a mature, value driven asset class. And most importantly, what that means for the critical 2026 to 2031 investment cycle.
Okay, let's dive right in. The first piece of evidence for this huge structural shift is just the sheer scale of the capital. We're looking at nearly 87,000 crore rupees in investment volume in 2025 alone. Now, this isn't just random money being thrown around. It's being channeled into 131 tightly regulated projects, all approved by HRERA. This combination of massive capital and strict oversight shows that Gurugram is really decoupling from the broader NCR, becoming India's premier spot for institutional money.
Now, this tells a really powerful story. If you look at the chart, you'll see a clear split. Prices are up a staggering 24% year on year, while the number of new launches has actually dropped by 11%. So what does that mean? Well, this isn't a slowdown, it's a strategic recalibration. Developers are intentionally limiting the lower margin supply, which is forcing prices up and creating a decisive pivot toward the premium segment, where properties over 2.5 crore now make up 59% of all new launches. So we've established the what and the why behind Gurugram's maturation. Now let's get into the where. Because the primary catalyst unlocking all this value is infrastructure. It's creating clear, predictable arbitrage opportunities for investors who know where to look. You might look at this and think it's just a government document, but it's not. It's basically an investor's roadmap for a future city of over 4 million people. Just look at the numbers. It explicitly allocates a massive 47.3% of new land to residential development while mandating new commercial corridors. This gives us a highly predictable, risk-adjusted blueprint of exactly where capital appreciation is designed to concentrate. And that brings us to a prime example, the Dwarka Expressway. This is no longer a speculative what-if, it's an imminent operational reality. The target for completing the critical service roads is May 2026. Now, that date is the final trigger for unlocking the value of sectors 102 through 115. Investing here now is essentially what we call infrastructure arbitrage. You're securing an asset at a pre-operational price to sell at a post-operational premium. And this slide brilliantly illustrates a core principle of real estate. Time compression equals value expansion. Think about it. The new 4.2-kilometer elevated corridor on the southern peripheral road will slice a 45-minute commute down to just 15 minutes. And the proof that this value is real? Just look at Signature Global's new 7-acre project on the SPR. They are targeting a massive 5,000 crore rupee revenue. That tells you developers are already pricing in that post-corridor valuation. Finally, let's look at the 28.5-kilometer metro loop. This project is the final piece of the puzzle. It's the one that truly institutionalizes the market. It's like a circulatory system, unifying micro-markets that used to be completely separate. With trial runs slated for mid-2028, this expansion turns the city's real estate from a collection of isolated gated islands into a deeply interconnected metropolitan grid, which helps shield properties near the metro nodes from broader economic downturns. All right, we've covered the infrastructure catalyst. Now let's pivot the analysis from the where to the who and what, meaning the key developers driving the market and the new benchmarks they're setting. I want you to just take a moment to look at this number. 1.1 lakh rupees per square foot. This isn't some future projection either. It's a resale benchmark that has already been achieved at DLF's Camellias. This has single-handedly redefined the absolute ceiling for ultra-luxury real estate in all of India. And here's the story behind that number. DLF has basically created a new asset class, what we're calling the trophy residence. With zero gross debt in its development business and achieving nearly 16,000 crore in bookings for units that average 72 crore rupees each, these assets are functioning less like homes and more like blue-chip art or sovereign bonds. They're hyper-resilient stores of generational wealth, completely immune to things like interest rate fluctuations. You see, the modern high-net-worth individual isn't just buying square footage anymore. They're buying into curated ecosystems. This slide shows the 3 main pillars of this new luxury boom. You've got global fashion brands like Elisa partnering with M3M, you have wellness-focused living from developers like Godrej, and then you have skyline-altering vertical landmarks like Tulip Mansella. And the result? These branded residences consistently command a 20 to 30% price premium. Okay, let's get granular.
We're now going on a geographic tour of the key investment zones, connecting all these developer strategies and infrastructure plays to specific sectors on the map. First up, Sector 37D, the core of the Dwarka Expressway. We're defining this as the upper middle-class stronghold. Why? Because it represents the perfect bridging asset. It's capturing the huge wave of senior professionals who are priced out of Golf Course Road but still demand those identical luxury specs. With inventory overhang shrinking to just 19 months, this specific ticket size is seeing some serious supply-side exhaustion. Now shifting over to the SPR corridor, sectors 69 to 75. This is what you'd call the steady and compounding play. It's anchored by these eco-conscious, green space-heavy projects like Tata Primanti and Conscientines Elevate. This corridor offers lower volatility than the Dwarka Expressway, but it promises higher baseline rental yields, all thanks to its proximity to established commercial hubs. It's a solid, long-term, stable growth opportunity. Now let's go back to the Dwarka Expressway and look at sectors 102 to 115. Something fascinating is happening here. There's this developer duopoly where, in the very same zip code, you have M3M selling ultra-luxury penthouses for nearly 27 crore rupees, right next to smartly planned two-bedroom apartments from Tata that start at 1.15 crore. This creates an incredibly deep wealth catchment, capturing demand across the entire high-income spectrum. And we can't ignore New Gurgaon, sectors 81 to 99. This is the demographic engine of the city. While DLF grabs all the luxury headlines, developers like Vatika and MR are building entirely self-sustaining 500-acre-plus ecosystems out here. This zone represents the most stable, volume-backed real estate in the city, perfectly insulated from the shocks and volatility of the ultra-luxury market. Okay, for any serious investment thesis, we have to talk about the risks. So let's shift to a direct, no-nonsense assessment of the red flags that every sophisticated investor needs to consider in this new landscape. The crucial takeaway here is that risk itself has evolved. Thanks to HRERA, developer fraud is largely a thing of the past. The new systemic risks are environmental. First, mandatory construction and demolition waste verification starts in April 2026. Second, recurring winter construction bans will inevitably delay project cycles. And third, and this is perhaps the most critical, tail-end sectors like 81 to 99 are facing significant groundwater scarcity. Now, these aren't deal breakers, but they are absolutely variables that have to be priced into any serious investment model. So, having analyzed the market structure, the catalysts, the players, and the risks, let's synthesize all of it. This is it, the final 2026 to 2031 investment playbook, a definitive strategy based on all the data we've just gone through. And here it is, the final verdict, laid out in a clear matrix. Let me be blunt. The era of speculative flipping in Gurugram is dead. The only viable strategy now is the quality-anchored long-term hold. For aggressive growth, capital has to flow into those infrastructure arbitrage plays in sectors like 37D and along the SPR before May 2026. For pure wealth preservation, the zero-debt, trophy assets from developers like DLF remain the untouchable choice.
So let's just recap the critical takeaways. 1. Gurugram is now a mature, value-driven market. 2. The peak opportunity is infrastructure arbitrage, specifically before May 2026. 3. H&I trophy assets are for wealth preservation, while the upper middle-class segment is best positioned to capture that infrastructure upside. 4. Your strategy has to prioritize zero-debt developers. And 5. You absolutely must price in the risk of environmental friction, especially water scarcity.
We've laid out the data, the catalysts, and the strategy. The playbook for Gurugram has been completely redefined, moving away from speculative growth to a mature, value-anchored hold. So the only question that remains is, how will you allocate your capital in India's premier real estate arena?